Hello, in this video we will discuss about money laundering in detail. So, what is money laundering? The conversion or transfer of property, knowing that such property is derived from a criminal offense for the purpose of concealing or disguising the illicit origin of the property or of a assisting any person who is involved in the commission of such crime to evade the legal consequences of such action. The concealment or disguising of the true nature, source, location, disposition, movement, rights with respect to or ownership of property, knowing that such property is derived from a criminal offense. The acquisition, possession, or use of property, knowing at the time of receipt that such property was derived from a criminal offense or from participating in such crime. The participation in association to commit, the attempt to commit, and the aiding, abetting, facilitating, and counseling in the commission of such act. Why is money laundered? So, what are the reasons behind money laundering? The principal motive for money laundering include to evade the legal consequences that come with the action, to avoid the punishment for money laundering, which include uh, con- uh, confiscation and forfeiture of the proceeds or assets involved in the crime, to conceal the criminal and illegal activities to the launderer, to conceal the criminal source, origin, destination, and beneficiaries of the illegal and criminal funds or assets so acquired. Financial Action Task Force, that stands for FATF, defined money laundering as the processing of laundering criminal proceeds to disguise their illegal origin in order to legitimize the ill-gotten gains of crime. How is money laundered? The process of money laundering are in the three stages associated with the crime. These three stages could occur concurrently or over time, which are: first one is placement. This is the first stage in the money laundering process by which criminal proceeds are introduced into the legitimate economy through products and services offered by financial institutions, including banks, insurance companies, or stockbroking firms. It could also be through designated non-financial businesses and professionals like casinos, online gaming, supermarkets, hotels, real estate and property companies, lawyers or accounting firms, client accounts, etc. This is the most visible stage of money laundering, where such proceeds are usually broken into smaller units of transactions by individuals in techniques called structuring or smurfing, where it involves multiple number of individuals. Part Point number two, layering. So this is the second stage in money laundering, where complex layers of transactions are conducted to achieve the following: concealment and disguise of the source and origin of the proceeds, separation of the proceeds from the ultimate beneficiaries, and breaking the audit trail. A typical example of layering through a bank would involve complex wire transfers in different financial institutions across multiple jurisdictions, mainly to erase or break the transaction trail. This is known as breaking the audit trail. Once the trail between the source of the proceeds of crime and the ultimate beneficial owner is broken and cannot be recreated by law enforcement agencies, the perpetrators move to the last stage. That one is integration. This is the last stage where the proceeds of crime have now changed form. They have been converted into legal assets. The legal assets are now reintroduced as legitimate proceeds. So how does it work? So let's suppose this is the dirty money that has to be laundered. So it is from corrupt activities and narcotics. So this one will be moved to placements. So placement means banked in financial institutions or to pay for insurance as premium. Then it comes layering by being moved to several offshore accounts or assigning the investment funds to offshore beneficiaries. So the money will be moved to offshore accounts. Integration. So by investing the funds in various business ventures, so the money that has been moved to offshore accounts will then be invested in different businesses. So then it becomes clean money. So then comes out as clean money through business revenue or claims. Sources or proceeds of crime. So the Financial Action Task Force has provided a list of 21 offences classified as the primary sources of proceeds for money laundering. These crimes are commonly referred to as predicate offences. So this is the list of crimes, list of offences. First one is participation in an organized criminal group or racketeering. Terrorism, including terrorist financing, trafficking in human beings and migrant smuggling, sexual exploitation, including sexual exploitation of children, illicit trafficking in narcotics, drugs and psychotropic substances, illicit arms trafficking, illicit trafficking stolen and other goods, corruption and bribery, fraud, counterfeiting currency, counterfeiting and piracy of products, environmental crime, murder, grievous bodily injury, kidnapping, illegal restraint and hostile taking, robbery or theft, smuggling, tax crimes that is related to direct taxes and indirect taxes, extortion, forgery, piracy, insider trading, and market manipulation. So, a predicate offense can therefore be defined as an illegal or unlawful activity conducted with the sole purpose of generating proceeds. Terrorist financing. So, what is terrorist financing? First, terrorist financing refers to the provision of funds with the intention of being used to support individuals or organizations that are involved in terrorist activities. It may involve fund raised from legal or illegal sources. Such sources like donations from individuals, profits from businesses, charitable organizations, or funds from criminal sources like proceeds from sales of drugs, smuggling of arms and other article of mass destruction, fraud, kidnapping, extortion, currency counterfeiting, and robbery, etc. Terrorist means a person who commits or attempts to commit a terrorist act or who participates in or facilitates the commission of a terrorism act. Terrorism financier refers to an individual or entity that directly or indirectly, intentionally or illegally makes funds available with the intention that they should be used or with the awareness that they are to be used for terrorist activities. So that is called terrorism financier. Financial transactions linked to terrorist financing does not need to involve large sums of money and oftentimes are not very complex compared to money laundering. But funds raised from legal sources for the financing of terrorism is difficult to detect as the individual or entities providing the finance to enhance terrorist activities usually make efforts to conceal the real source of the funding being provided. Differences between money laundering and terrorist financing. So this is the difference between these two terms. So first one is the first factor is motivation. So in money laundering, the factor is profit, and in terrorist financing, the motivation is ideological. Source of funds internally from within criminal organizations, and in this one internally from self-funding cells, generally centered on criminal activity. uh, Conduits favors a formal financial system. Here the favor here it favors cash, courier, or informal financial systems such as hawala and currency exchange firms. In money laundering, the detection is suspicious transactions such as deposits, uncharacteristic customers' wealth, or the expected activity which lead to relational links. Here, The detection focuses suspicious relationships such as wire transfer between seemingly unrelated parties, which lead to transactional links. In money laundering, the transaction amount is large amount, often structured to avoid reporting requirements, and here the transaction amount is small amounts, usually below reporting thresholds. Financial activity. In money laundering, the financial activity is a complex web of transactions often involving sell or front companies, bearer shares, and offshore secrecy haven. Here, the financial activity is no workable financial profile of operational terrorist attack exists according to US 9/11 Commission. In money laundering, the money trail is circular. Money eventually ends up with the person who generated it. So in terrorist financing, it is the money trail is linear. That means money generated is used to propagate terrorist group and activities. Similarities between money laundering and terrorist financing. So they are both designated criminal groups and activities. They will do everything to hide their sources and channels. They are both economic saboteurs and destroyers. They are both very dynamics and keep changing their tactics and strategies. They operate in webs and cartels. On the other hand, terrorism financing is funding of terrorism activities and that of designated terrorist group with either a legitimate or legitimate source of funds. Sanction. A sanction is a penalty imposed by a country or group of countries on individuals, organizations, or countries by restricting access to target funds or assets, thus preventing the target individuals, countries, or organizations from having access to financial system and international trade. Sanctions can take a number of forms, but the most relevant types of sanctions for businesses are financial and trade sanctions. They can include arms and trade embargoes, travel bans, asset freeze, reduced diplomatic links, termination of any military relationship, flight bans, suspension from international organizations, and withdrawal of aid. What is the importance of sanctions? So, sanctions have become an effective tool of choice for different countries of the world to exert pressure on other countries, individuals, and organizations in dealing with threats to national security. Sanctions are used as a strong weapon in the fight against terrorism. Effective sanction system helps financial institutions globally to minimize the risk associated with financial crimes. Non-compliance with sanctions constitutes an offense. Financial institutions are to act as a gatekeepers whose role is to identify undesirable elements in the financial system and prevent them from consummating undesirable transactions. So the sanction list is available to United Nations list, Her Royal Majesty list in UK. It is also available in Office of Foreign Assets Control, that is in US, and the European Union list, and also with local regulators like CBN, NFIU, EFCC. So let's practice some of the content that we have read. Which of the following is not a proper description of money laundering? Okay, there are four options: A, B, and C, and D. First one is, it is the process of concealment of illicit funds. It is the concealment of origin, ownership, movement, and purpose of illegal funds or assets. It is the process of laundering of funds. It is the process of integrating illegal funds to appear as if it is were derived from legitimate source. So one of the option is actually not a proper description, and it is the third one. So it is the process of laundering of funds. So it is not the process of laundering of funds. Right. Next question is, a predicted offense is, first option is an illegal or unlawful activity conducted with the sole purpose of generating proceeds. So this one is the correct answer. Other ones are also, the second option was an illegal or unlawful activity conducted by a banker seeking to meet his target. Third option is an illegal or unlawful activity conducted to hide some errors that may result in penalties. An illegal or unlawful activity conducted to minimize loss. So the first one is the correct answer. Next question is, which of the following is not is source of terrorist financing? So drug trafficking can also be a source of terrorist financing. Tax evasion can also be a source. Personal inheritance can also be a source, but cash transaction is definitely not a source. Next question is, which of the following is a true description of the factual difference between money laundering and terrorist financing? So there are four options here. First one is, only terrorist act is an illegal activity. That is not correct. Both are derived from proceeds of crime. This is not correct because money laundering is not derived from proceeds of crime. Only terrorist financing is actually derived proceeds of crime. While money laundering is transnational, terrorism financing is domestic. That is not also true because terrorist financing can also be came from foreign assets or foreign transactions. Money laundering is derived only from criminal activity, but terrorism financing is derived from both legitimate and illegal sources. Vulnerabilities of financial institutions to money laundering. So this is the next topic. So here we have a glossary of terms. First one is AML and CFT. So full form of AML is anti-money laundering, and the full form of CFT is countering financing of terrorism. Second one is CBN, that stands for Central Bank of Nigeria. CDD, that stands for Customer Due Diligence. EFT, Electronic Fund Transfer. FATF, Financial Action Task Force. FIU, Financial Intelligence Units. IPS, Internet Payment Service. ML, that stands for money laundering. NPM, that stands for new payment method. NPPS, that stands for new payment products and services. Next one is OECD. OECD stands for Organization for Economic Cooperation and Development. Next one is PEP, that is PEP, politically exposed person. Next one is PTA, payable through account. Next one is SRBs, that is self-regulatory bodies. STR means suspicious transaction report. TF means terrorist financing. P2P means person to person or peer to peer. P2B means person to business. B2B means business to business. Money laundering and terrorist financing vulnerability of financial services. So financial institutions such as banks, insurance underwriters, securities and brokerage firms, as well as money service businesses engage in activities related to monetary transactions such as deposit taking, loans and advances, investment management and currency exchange. So money launderers, terrorist financiers, fraudsters and other criminals are attracted to these FIs because they offer financial products and services that can be used to convert, conceal and disguise proceeds of crime and other illegal activities in order to escape the legal consequences and punishment that come with the act. Money launderers and terrorist financiers therefore see FIs as conduits, vehicles and tools to achieve the schemes and scams of their trade. They are not interested in meaningful, long-term, mutually beneficial business relationships. The most common deficiencies that make banks vulnerable to money laundering and terrorist financing activities include the following. inadequate governance and oversight of money laundering risk, inadequate risk assessment process to identify high risk customers, poor management of high risk customer and politically exposed persons, particularly in relation to establishing the source of wealth and funds of those politically exposed persons, inadequate due diligence on correspondent banks. So, inadequate or poorly calibrated AML or sanctions screening system, improper handling of alerts relating to sanctions and transaction monitoring, poor judgments or questionable decisions leading to the organization taking unacceptable money laundering risks. How financial institutions are vulnerable to money laundering and terrorist financing. The techniques and methods of money laundering and terrorist financing typified by placement, layering and integration are all made possible in reporting institutions through their products and services, delivery channels, locations, and other customer related services. Money launderers and terrorist financiers use FIs in the following ways to achieve their nefarious activities. First one is as collection points or channels for the proceeds of their illegal activities, to store and move the proceeds of their crime, to conceal the source and origin of their proceeds, to disguise the beneficiaries and destination of the proceeds, to convert proceeds of crime into acceptable assets, to separate themselves from the proceeds of crime by breaking the audit financial trail. Techniques and methods employed include structuring, smurfing, complex wire transfer transactions, use of shell companies and offshore financial centers. The banking industry. The banking subsector appears to be the channel most vulnerable to money laundering activities due to its size, complexity, the range of products and services, the transaction volume, as well as sectors interconnectedness with international financial system. The most common deficiencies that make banks vulnerable to money laundering and terrorist financing activities include the following: inadequate governance and oversight of money laundering risk, significant gaps in risk assessment proceeds to identify and manage high risk customers, poor treatment of politically exposed persons, particularly in relations of uh, establishing the source of wealth and fund of those PEPs. Weaknesses in the weaknesses in the due diligence processes on correspondent banks, inadequate or poorly calibrated AML sanctions screening systems, improper handling of alerts relating to sanctions and transaction monitoring, poor judgments or questionable decisions leading to organization taking unacceptable money laundering risk. Financial products that are vulnerable to money laundering and terrorist financing. Some of the products that are vulnerable to money laundering and terrorist financing schemes include the following: private banking, wire transfer, international correspondent banking, payable through accounts, electronic banking, new payment methods, bearer securities, bills of exchange, variable annuity. Private banking vulnerabilities. So, private banking offers personalized and discrete delivery of a wide variety of financial services and products to high net worth individuals who generally, on average, have minimum investable assets of $1 million. Private banking accounts can be opened in the name of an individual, a commercial business, a law firm, an investment advisor, a trust, a personal investment company, or an offshore mutual fund. Private banking services almost always involve a high level of confidentiality regarding customer account information. In managing their customers' financial affairs, private banking often form offshore vehicles for their customers called shell companies. So, private banking products that could pose unique vulnerabilities to money laundering include the following: personal investment corporations that are owned through bearer shares, omnibus or concentration of accounts. There are various there are a variation of suspense accounts which are legitimately used by banks, among other things, to hold funds temporarily until they can be credited to a proper account. The use of omnibus or concentration accounts by private banking customers that seek confidence, confidentially for their transactions poses an increased vulnerability to banking organizations that the transactions could be the movement of illicit funds. Such accounts can be used to purposefully break or confuse an audit trail by separating the source of the funds from their intended destination. Private banking vulnerabilities mitigates senior management oversight of private banking activities, development of a sound risk management process that ensures adequate control environment. This should be communicated effectively to uh, engender the application of consistent practices by the organization personnel. Due diligence policies and procedures that require banking organizations to obtain identification and basic information from their customers, understand sources of funds and lines of business, and identify suspicious activity. Management information system that provide timely information necessary to analyze and effectively manage the private banking business and to monitor for and report suspicious activity. Adequate segregation of duties uh, to deter and prevent misconduct, unauthorized account activity, and unapproved waiver of documentation requirements. What are the wire transfer vulnerabilities? So, wire transfer is a method of electronic funds transfer from one person or entity to another. A wire transfer can be made from one bank account to another bank account through a transfer of cash at a cash office, through money remittance providers. Features of the money remittance services that make them attractive to money launderers and terrorist financiers are the simplicity and certainty of transactions, worldwide reach, the cash nature of transactions, low thresholds, relaxed customer identification rules that apply to such transactions compared with opening bank account, the possibility of waiver of verification of the customer's identification, the informal nature of the customer relationship with the money remittance service providers, especially in the case of underground money service providers, example Hawala. What are the wire transfer vulnerabilities and mitigates? So these are the vulnerabilities, and this one is mitigates. So vulnerabilities is indication of possible misuse of this product for money laundering or terrorist financing. Activities include the following: use of underground remittance systems. use of mules or strawman, mismatch between the economic activity, country of origin of or person and the money remittance received or receiver. Periodic transfers made by several people to the same beneficiary or related persons. Transfers over a short period of time of low amounts that together represent a large sum of money. Transfer from one or more senders in different countries to a local beneficiary. Sudden inflow of funds in cash followed by sudden outflow through financial instruments such as drafts and checks. Restructuring of transactions and or changing of money. Remittance currency exchange provider for subsequent orders to keep a low profile. And customers providing false information or refusing to provide required information. So what are the mitigates? Mitigates are licensing of the money remittance service provider and agents to enhance the regulation of their activities. Implementation of robust AML programs by money remittance service providers and agents. Proper identification of senders and recipients. Confirmation of the sources and destination of funds. Ongoing monitoring of customers' transactions. International correspondent banking vulnerabilities. So a correspondent account is an account often called a nostro or vostro account established by a banking institutions or to receive deposits from, make payments on behalf of or handle other financial transactions for another financial institution. So vulnerabilities are significant money laundering and terrorist financing risks in correspondent banking relationships include identification and due diligence challenges. The domestic bank carrying out the transaction has to rely on the foreign bank to identify the customer, determine the financial owners, that is, real owners, and monitor such transactions for risk. Regulatory and supervisory challenges. The foreign bank has AML compliance systems built for its local country of operation and may not necessarily be capturing all of the information and potential risk imposed by the correspondent bank's local regulatory system. In reality, the correspondent bank is required to impose regulatory requirements from its jurisdiction on the foreign bank for the foreign bank's customers. Mitigates. Adopt a risk assessment and risk ranking process for correspondent banking relationships. Maintain certain mandatory records for foreign correspondence accounts. Prohibit the maintenance of accounts for cell banks. Access the AML CFT controls of respondent banks. Ensure senior management approvals of correspondent relationships. Payable through account. What are the vulnerabilities and mitigates? Vulnerabilities are a payable through account. PTA is a demand deposit account which banking agencies located in jurisdiction extend check writing privileges to the customers of other institutions, often foreign banks, with a payable through, pass through, or pass by account. A foreign financial firm is able to create a corresponding account in that jurisdiction. The foreign bank then provides checks to its foreign customers who might be interested in conducting foreign transactions. The vulnerability presented by this banking product is that foreign customers of a foreign bank is granted access to the financial system of the correspondent bank's jurisdiction without being subjected to the AML CFT screening often exercised over the correspondent bank's own domestic customers. Mitigates. To mitigate the risk of money laundering with respect to payable through accounts, FATF recommends that the correspondent bank should be satisfied with that the respondent bank has verified the identity of and performed ongoing due diligence on the customers having direct access accounts of the correspondent, and that it is able to provide relevant customer identification data upon request from the correspondent bank. Electronic banking. What are the vulnerabilities and mitigates? So electronic banking broadly refers to delivery of information, products and services by electronic means such as telephone lines, personal computers, automated teller machines, and automated clearing houses. This product offering continues to grow at a rapid pace. Although the extent of services varies, typical or electronic banking services include credit cards, debit cards, loans, deposit, wire transfers, and bill paying services. What are the vulnerabilities? Electronic banking is vulnerable to money laundering and terrorist financing because of the following features. Its user anonymity. The use of electronic banking affords the user anonymity since there is virtually no contact with the system that will require identification. Rapid transaction speed. Electronic banking allows transfer of large amounts of funds at a very high speed. Its wide geographic availability. Funds can be transferred from one jurisdiction to another, thereby confusing the audit trail. Jurisdictions with weak legal framework. A weak anti-money laundering procedure in one country can lower the effectiveness of combating illegal financial operations in other countries. Mitigates. Impose strict identification of users, uh, establish and implement transaction limits, impose and maintain strict regulatory controls, ensure licensing of the operation of electronic banking. Combating the abuse of virtual currencies, emerging technologies, and new payment methods in financial institutions. The rapid development, increased functionality, and the growing use of virtual and digital currencies, new payments and new payments products and services, and emerging technologies have created new challenges for financial institutions in ensuring that these products and services are not misused for money laundering and terrorist financing purposes. NPPS includes a variety of products and services that involve new ways of initiating payments through or extending the reach of traditional retail electronic payment systems, as well as products that do not rely on traditional systems to transfer value between individuals or organizations. There are three categories of NPPS. First one is prepaid cards, mobile payment services, internet based payment services, virtual currencies. Traditional financial services such as retail, commercial, and private banking services are increasingly being offered through these new and innovative ways. Combating the abuse of virtual currencies and emerging technologies and new payment methods in financial institutions. So, a typical case of third party funding is the use of digital currency exchanges or virtual bureau de-change. These exchanges can circumvent an internet-based payment services provides ban on certain funding method. Example: no cash funding policy. If they accept the banned payment methods when reselling the issued digital currency or electronic money funds. Further, the provider, that is FI, will only see the exchanger's name in its monitoring, but will not see who actually instructed the exchanger to fund the account. A large number of parties involved in the provision of NPPS, especially when spread across several countries, can increase the money laundering or terrorist financing risk of the product due to the potential of segmentation and the potential loss of customer and transaction information. It should therefore be clearly established which of these entities should are subject to AML or CFT obligations and who is responsible for complying with such obligation. Establishing who is responsible for regulating and supervising compliance with AML or CFT measures in the transaction process is also very important. Financial institutions should identify, assess, and understand the risk posed by the NPPs they provide before establishing their CDD processes and procedure. In particular, FIs should undertake this risk assessment with a particular focus on money laundering or terrorist financing risks posed by new products and business practices, including delivery mechanism and the use of new technology prior to their launch. Placing limits on NPPs can be an effective mechanism to mitigate uh, these risks, as long as it is combined with other AML or CFT measures such as account and transaction monitoring and filing of STRs. Setting geographical or reloading limitations also mitigate the risk that NPPs may be misused for these purposes. Given that these risk increases as the functionality of the NPPs increases, financial institutions could consider establishing individual tiers of services provided to customers. This should be developed on a case by case basis during the design phase of new NPPs. Financial institutions as NPPs providers should consider the source of funding when assessing the money laundering or terrorist financing risk of NPPs could consider restricting the permissible sources of funding for that product. Anonymous sources of funding such as cash or even other NPPs that are anonymous increase this risk. Record keeping, transaction monitoring, and reporting are also key in mitigating and combating the risk of NPPs in FIs. Prepaid cards, what are the vulnerabilities and how it can be mitigated? So vulnerabilities are many prepaid cards enable customers to make both domestic and international payments as well as receive payments from third parties. They can allow cross-border remittance, example by issuing twin or partner cards to one customer, which can be passed on to remittance receiver anywhere in the world. These cards are vulnerable to because of their anonymity. Prepaid cards can be obtained without any customer identification or by using fake or stolen identities. Prepaid cards are also vulnerable to money laundering and terrorist financing risk when such cards have high or no transaction limit, especially when they are passed on to third parties who are beneficial owners but are not identified. Method of funding can also be determine the vulnerability of the prepaid cards. Anonymous cash funding, third party funding, and indirect funding through IPS and mobile payment system heightens money laundering and terrorist financing risk. NPM products that have wider geographical reach and cross-border functionality pose higher risk and are more attractive to launderers. So, what are the mitigates of these vulnerabilities? Implement good identification and verification and CDD measures. Use only well-trained and regulated agents for sales and distribution of prepaid cards. Implement transaction monitoring systems. This will also result in effective reporting. Set transaction limits using a risk-based approach. Restrict funding methods to sources that providers can easily verify. Restrict funding to where providers can rely on another institution's CDD measures such as previously identified bank accounts, credit or debit cards, or other personalized payment methods. Restrict the number of parties that can fund the card. Mobile and internet payment services. So mobile payment features are there are four categories of mobile payment systems described by the World Bank. Uh, First one is mobile financial information systems. User may view personal account data and general financial information but there is no capability for any financial transaction and therefore may be considered low risk. Mobile bank and securities account services specific to individual bank or security accounts and is regulated and supervised. It is similar to internet banking. Mobile payment services allows non-bank and non-securities account holders to make payments with mobile phones. Payment service provides maybe non-traditional financial institutions with widely varying controls and supervision measures. Last one is mobile money services. Subscribers are able to store actual value on their mobile phone. They may also use phone credits or airtime as standards for payment. Such systems offer versatility, but may often not be regulated and may not be under prudential supervision. Internet payment features. Internet payment services that stand for IPS can be provided by financial institutions and firms outside the financial services sector, relying on or operating independently from a bank account. There are three categories of internet payment methods. Online banking, where financial institutions offer online access to traditional banking services based on an account held at institutions in the customer's name. Prepaid internet payment products, where firms who may not be financial institutions allow customers to send or receive funds through a virtual prepaid account accessed through the internet. Digital currencies, where customers purchase units of digital currencies or precious metals, which can either be exchanged between account holders of the same service or exchanged against real currencies and withdrawn. Mobile and internet payment services, vulnerabilities and mitigates. So vulnerabilities are the risk factor that make mobile and internet payments method vulnerability to money laundering and terrorist financing are anonymity or lack of identification of recipients of the service. Funding method, anonymous funding by cash, third party funding and indirect funding through IPS and mobile payment services which are account based. Weak record keeping, high or no transaction limits, wide geographical reach and cross border functionalities, usage limits, segmentation of service. So these are the mitigates of mobile and internet payment services. Establish good KYC and CDD measure, installation of transaction monitoring systems to track users activities, setting transaction limits using a risk based approach, restrict funding methods to sources that providers can easily verify, restrict funding to where providers can rely on another institution's CDD measures such as previously identified bank accounts, credit or debit cards, or other personalized payment methods. Virtual currencies and new technologies. The Financial Action Task Force (FATF) recommends 15 aspects uh, reporting entities to identify and assess the risk of new technologies before adoption by financial institutions. Financial transactions have become increasingly digitalized due to new emerging payment systems. One of the most recent is blockchain technology that is behind virtual and digital currencies. In 2008, Satoshi Nakamoto published an open source peer-to-peer electronic cash system which gave birth to the first digital currency known today as Bitcoin. Since then, several investors have developed the Satoshi model to create different types of virtual currencies, some of which now pose serious threats to the effort of law enforcement agencies at combating the risking wave of crime, money laundering, and terrorism financing. Digital currencies are virtual currencies, but not all virtual currencies are digital currencies. Virtual currencies operate solely within the internet ecosystem and are not convertible to fiat money. Example of virtual currencies are those created by online gaming sites, gambling sites, and casinos solely for their patrons. Digital currencies, on the other hand, are convertible to fiat money. In understanding the architecture of the virtual currency framework, notable players are miners, users, administrators, and exchangers. Miners are those who devote their resources to electronically create the digital currency. Exchangers are those who trade in the digital currency and act as bureau de change in converting the fiat money to a digital currency and vice versa. Financial institutions are particularly vulnerable to the activities of the exchangers because most of the operators conceal information about their businesses activities to the reporting entities and operates without required regulatory approval and framework. The attention of the law frame enforcement agencies all over the world have been drawn to activities of criminals now using digital currencies to convert, conceal, and disguise the proceeds of crimes. According to the FATF, trace-based currency money laundering is defined as the process of disguising the proceeds of crime and moving value through the use of trade transactions in an attempt to legitimate their illicit origins. There are three main methods by which criminal organizations and terrorist financiers move money for the purpose of disguising its origins and integrating it into the formal economy. These are through the use of the financial system by moving value through checks and wire transfers, physical movement of money through the use of cash couriers and bulk cash smuggling, through the physical movement of goods through the trade system by false documentation and declaration. Hawala and other Hawala and other alternative remittance system vulnerability to money laundering and terrorist financing. The word hawala comes from originally from the Arabic language and it means transfer or remittance. Hawala provides a fast and cost-effective methods for worldwide remittance of money or value, particularly for the financially excluded. In many countries of the world today, hawala is illegal. The operators of the hawala practice are called hawaldars and other alternative remittance systems that stands for ARS or informal value transfer system IVTS including Hundi cheat system, Poiquian and the black market peso exchange. The very feature that makes Hawala attractive to legitimate customers efficiency, anonymity and lack of paper trail also make the system attractive for the transfer of illicit funds. Vulnerabilities in non-bank finance sectors and securities. The operators in the securities subsector or industry include the stockbrokers, portfolio managers, finance and investment advisors, finance houses, discount houses, and other capital market operators. Money laundering in the securities industry occurs primarily at the layering and integration stages because of the nature of products instruments. First, the assets need to be introduced into the financial system. The industry provides the money launderer with a double advantage. The ability to launder illicit assets generated from outside the securities industry and the ability to use these external illicit assets to generate additional illicit assets within the securities industry. For example, through market manipulation and securities fraud. So these are the example of securities products that are susceptible to money laundering and terrorist financing include equities, bearer bonds and similar debt instruments, bill of exchange, unit trust, certificate of deposits, investment trust, mutual fund, open-ended investment companies, open-ended collective investment schemes, closed-end companies, options, futures, swaps, forward rate agreements, commodity derivatives contracts, foreign exchange contract. So what are the vulnerabilities in non-bank finance sectors and securities? So even though money laundering occurs primarily at the layering and integration stage in the securities subsector, certain securities products pose identifiable these vulnerabilities even at placement stage. Examples include physical securities, including bearer securities and bills of exchange. Bearer securities consist of both physical equity and debt securities that, unlike registered securities, do not necessarily require that the owner be registered with an issuer or a transfer agent. The transfer of bearer securities can be made as simple as handing the security over to a new owner. The transfer can also occur electronically, which can inhibit tracking any change of ownership. In addition, some bearer bonds are almost equivalent to cash because they can easily be redeemed at financial institutions. The anonymity and easy transferability of bearer securities present a significant money laundering and terrorist financing vulnerability at all three stages of money laundering. Illicit assets can be introduced into the securities industry at the placement stage through the purchase of bearer securities. Once a bearer security has been issued, money launderers or terrorist financiers can hold these securities or transfer them to an intended recipient without necessarily having to use facilities that would record a transaction, conduct CDD, or impose KYC obligations. Recipients or for bearer securities can deposit them into brokerage accounts in order to purchase other assets or liquidate them and withdraw or wire transfer their proceeds out of jurisdiction, thus layering and integrating the illicit assets. Bearer securities can also be used to conceal the identities of the beneficial owners of shell companies. What are the non-bank finance sectors and securities vulnerabilities and how we can mitigate them? In some jurisdictions, bills of exchange are treated as securities. A bill of exchange, example check or bank draft, is a written unconditional order by a drawer to a drawee to pay money on demand or at a fixed or determinable future time to a payee. That means payee means the specified person or to the bearer. So the vulnerabilities are bills of exchange can be payable on a site or at a future date and can be transferred by more endorsement or signature. The risk posed by bills of exchange is similar to that of bearer security, ease of transfer and redemption. Portfolio managers and mutual funds manager control huge pool of funds that flows from diverse sources and investors with several product options as listed above. This is an attraction to machine learning to push in their funds into several of those investment options using different security operators. The ease of entry and exit of investors, the weak regulatory oversight against ML, collection of cash by some operators, and strong regulatory focus on banks at the expense of other financial service sectors, among others, heightens the vulnerability of the security industry to the money laundering and terrorist financing risk. Bearer securities are susceptible to money laundering because the owner need not registered with the issuer of the security, so it can easily be transferred without the need or to leave a paper trail. Mitigates To mitigate the risk of money laundering and terrorist financing in the security subsector, proper collaboration and reliance on other parts of the financial sector to conduct certain aspect of CDD as a perfectly acceptable way to facilitate transactions in the global financial system. A strong industry AML CFT framework and its regulators take appropriate steps to ensure that reliance is only placed on third parties with adequate AML CFT systems and controls. CDD should be performed on the funds flowing into the sector for investment, and this is more than just customer identification. It extends to ascertaining the purpose and intended nature of a transaction with funds from another part of the financial sector. Uh, Practice questions 1. So the question is, the financial services sectors offer a very attractive channel for the money launderer, fraudster, the terrorist financier, and the other criminals because of the following. First option is the various products and services offered by this sector can be used to convert, conceal, and disguise the proceeds of crime and other illegal activities in order to escape the legal consequence and punishment that come with the act. Second option is the institutions engage in activities related to monetary transactions for which approval is not usually obtained from regulators before consumption. Criminals, money launderers, and terrorist financiers can fulfill all account opening documentation and are always willing to provide all required documents. The last option is, and this one is correct option, financial institutions do not have to disclose the sources or the destination of the funds once the customer opening the account has been fully identified. Second question is, all money coming to Nigeria are captured through banks, true or false? False. Third question is, for money launderers and terrorist financiers to achieve their main objective of laundering illegal proceeds and accomplishing the terrorist act respectively, they need, first option is, a channel that will facilitate the movement of funds without exposing the source and the destination. Second option is to gather a group of illiterate and jobless young men and women to work for them. Third option is to be financial experts and religious bigots. Fourth option is to be highly connected to the rulers of a country and those and the who in the global space. So first option is correct, which is a channel that will facilitate the movement of funds without exposing the source and the destination.